Happy Monday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Asia, Europe, and North America. My name is Tony. We have a big week ahead of us. Let's jump in. Finance ministers from around the world are gathering in Washington, D.C. this week for the International Monetary Fund, IMF, and World Bank spring meetings. But the mood is anything but optimistic. As the Trump administration pushes ahead with a rapid-fire series of bilateral trade negotiations, concerns are mounting that broader global economic risks, including of financial crisis or even collapse, and especially those stemming from escalating tariffs, will overshadow any diplomatic wins. Central to the unease is the deteriorating global growth outlook. Since President Trump's dramatic 2nd of April Liberation Day announcement, unveiling steep what he called reciprocal tariffs on most imports, economists have been dialing down their forecasts. Karen Danan, senior fellow at the Peterson Institute for International Economics, now expects global GDP to grow just 2.7% in 2025, down from the prior 3.2%. Goldman Sachs sees growth falling even further to 1.4% year-over-year in Q4, less than half the 3% recorded at the end of last year. The IMF is also expected to revise its growth projections downward. The IMF managing director warned last week that while recession is not forecast, the new World Economic Outlook will reflect, quote, notable markdowns, end quote, in expected growth. The implications are clear. Even countries hoping to strike favorable trade deals with Washington will face a grim economic backdrop. Take Japan, one of the Trump administration's top trade priorities. While Japan would welcome lower tariffs on its exports to the US, high duties imposed on other key partners, such as China, Vietnam, and Mexico, threaten to weaken the broader ecosystems that support Japanese trade. Quote, trade wars are contractionary for the world economy, end quote, said Peterson Institute for International Economics economist Kimberly Clausing, adding, quote, reduced demand in one country ripples across borders, depressing export sectors elsewhere and complicating monetary policy responses globally, end quote. New research from the US-based Brookings Institution and the UK-based Financial Times confirms the stark shift in sentiment. Their joint tracking indices show a sharp decline in global economic confidence and a deterioration in financial conditions, especially in the US, China, and Germany. Eswar Prasad, a senior fellow at Brookings, emphasized that the breakdown in global trade and rising policy uncertainty are now powerful drags on growth. Meanwhile, Wall Street, once buoyant on expectations of corporate tax cuts and deregulation, has turned sharply cautious. Since Trump's tariff announcement, the S&P 500 has dropped over 7%, and 7 major banks have slashed their end-of-year targets. JP Morgan now sees the index finishing 2025 at 5,200, down from 6,500. Citigroup is forecasting 5,800, while BCA researchers Peter Berezin predicts an even bleaker 4,450, implying a 15% drop from current levels and a likely US recession within months. Quote, the Goldilocks sentiment in place entering this year has given way to complete uncertainty, end quote, said Citi analyst Scott Cronert. He warned that the recent turmoil could mark the first bear market explicitly triggered by presidential trade policy. Some commentators supportive of the US president's trade policies push back against much of this, however, arguing that a global trade reset, by its very nature, will be highly disruptive in the short term, and as such it is too early to say whether the policies have been successful or not. Nevertheless, as global leaders meet this week, the message is sobering. Even successful trade deals may offer little reprieve if the underlying global economy continues to buckle under the weight of uncertainty and this reset. The world is going through massive changes, and we are certainly living history. If you want to be on top of the most salient and important stories as we go through this transformation, make sure you're subscribed to Market Update, hit the bell notification icon, and you will be. If you're getting some value from today's episode, don't forget to hit the like button. Next up, the UK government's recent move to seize control of British steel from its Chinese owner, Jingye Group, has reignited debate over China's presence in key sectors of the British economy and triggered fresh calls for stricter scrutiny of foreign investment. Since 2000, more than $100 billion of Chinese capital has flowed into the UK, according to US-based Rhodium Group. Roughly a third of this investment has gone into critical sectors such as energy, transport and technology, raising concerns about national security and economic resilience. Labour Party officials have flagged particular risks in nuclear, telecoms and infrastructure, where Chinese ownership could pose strategic vulnerabilities. Energy has emerged as a central focus, accounting for nearly 20% of Chinese investment in major UK projects since 2005. State-owned giants such as China Investment Corporation, with stakes in Heathrow Airport and other major infrastructure, and China General Nuclear have played prominent roles. CGN is already a partner in the HPC nuclear plant and had been lined up for a new facility in Bradwell, Essex, until the UK government signalled plans to block the investment. Meanwhile, Chinese private capital has targeted real estate and strategic manufacturing, including auto brands and semiconductors. Zhejiang-based Geely owns UK factories for both the black cab maker LEVC and Lotus sports cars. However, investment has waned significantly. In 2023, Chinese FDI, foreign direct investment, into UK projects fell to just 3% of its 2017 peak, an incredible 97% collapse. Analysts attribute the drop to tighter UK regulations, Chinese capital controls and declining asset values, particularly in property. Despite the recent decline, the UK remains among the largest recipients of Chinese infrastructure investment in the OECD. Experts warn that rolling back Beijing's economic footprint will be difficult due to legacy deals struck before tougher screening policies were introduced. And finally for today, South Korea's acting president Han Duck-seo has declared that Seoul, quote, will not fight back, end quote, against sweeping new US tariffs, signalling a conciliatory approach ahead of high-stakes trade negotiations with the Trump administration. His comments come amid rising economic uncertainty, political upheaval at home, and a rapidly deteriorating trade landscape shaped by Trump's protectionist agenda. In an interview with the Financial Times over the weekend, Han acknowledged the historical debt South Korea owes to the United States, citing post-Korean War aid, investment, and security guarantees as critical to the country's transformation into a global industrial power. Quote, our industrial prowess, our culture, our growth, all of this is heavily due to the help from the United States, end quote, he said. This sense of gratitude underpins Seoul's decision to pursue compromise rather than confrontation. Despite being blindsided by new 25% reciprocal tariffs on South Korean exports, including automobiles, chips, and pharmaceuticals, Han emphasized the desire to craft win-win outcomes. He said South Korea is open to addressing Washington's long-standing grievances, from auto emissions rules and opaque drug pricing to restrictions on US beef and content streaming platforms like Netflix. The stakes are enormous. In 2024, South Korea posted a record $55 billion trade surplus with the US, which has now overtaken China as Seoul's largest export market. The Trump administration is linking trade and security in its talks with Seoul too, raising concerns in South Korea over demands for higher payments to support the 28,500 US troops stationed on the peninsula. Trump's tariff blitz, including a separate 25% auto levy and proposed duties on chips and EV components, poses a direct threat to South Korea's export-driven economy. Nearly half of South Korea's $70.8 billion in 2024 vehicle exports went to the US. Semiconductor exports, though still growing, are at risk if Trump moves forward with new national security investigations. Han, a technocrat, has faced questions about his legitimacy to negotiate such a consequential deal. Yoon Suk-yeol was removed from office earlier this month following an attempted imposition of martial law, and a snap presidential election is set for the 3rd of June. Critics argue Han's decisions could bind the hands of his elected successor, but Han defended his authority under constitutional law and declined to comment on whether he would run for president. Meanwhile, economic indicators are flashing warning signs in South Korea. Preliminary April trade data show a 5.2% decline in exports compared to a year earlier, with shipments to the United States plummeting 14.3%. Auto exports dropped 6.5%, steel 5.7%, and oil products 22%. Only semiconductors, up 10.7%, bucked the trend. The Bank of Korea held its benchmark rate steady at 2.75% last week, but warned of increased downside risks to growth due to trade headwinds and domestic political instability. A preliminary Q1 GDP estimate due this week is expected to show minimal growth or a contraction. As trade ministers head to Washington to kick off talks, South Korea hopes to secure a broad economic agreement. But with Trump tying trade to defense, and with domestic politics in flux, the path forward may be anything but smooth. Okay, that is today's episode of Market Update, the first of what is likely to be a very busy and consequential week. Make sure you're subscribed to be on top of these incredibly important developments as they happen this week. Thank you so much for watching today's episode. I hope you got some value from it. Have a good Monday, have a productive week, and I will see you for a new day of updates tomorrow.